Good afternoon. This is Tim with BIS Commodities, taking a look at the week in review, the week ending May 11th. Let's start and see where we closed for the week. November corn closed almost 10 cents lower on the week at 396 a half, and the July contract, July beans down 33 and a half cents at 1003 on the week. Was the closing bell. Wheat down 27 and a half cents, just under 4.99 for the week in the July contract. June cattle up $1.57 at 107.62. May hogs closed $1.77 lower at 65.30. Looks like oil is gonna close up about 81 cents or so, still trading at the time of this recording, 70.53 last. The dollar looks fairly steady on the week as well, even though we did make new highs on the week. We're trading fairly steady, so we've fallen off here towards the end of the week. The stock market looks as if it's gonna trading as well. Looks like it's gonna close maybe 520, 550 points up on the week as well. 24,770 area in the Dow. One of the big things this week was obviously the monthly supply and demand report, and not only for new crop but for old crop corn. Taking a look at the old crop balance sheet, we didn't see any change from the USDA there. Still kept that carry out at 2.18 billion bushels. The big question is what kind of number we're going to see on new crop. Once you threw in that 88 million acres, threw in a yield estimate and a projected demand number, it gave us a carryout of 1.6 billion bushels and change. It came in a little bit better than what the average trade guessed, but no big surprises there at all. I think what it's telling us now, that's a starting point for this year. So when we take a look here at the June charts, $4 in the July contract was a long time area of resistance. Once we popped through that, $4 became maybe a little bit of area of support going into this report. After today's close, that's going to be the key, the beginning of next week as far as the charts are concerned, closing below $4 with the weakness here at the end of the week. Something to take a look at technically. Fundamentally, though, with the report behind us and the 1.6 projected carryout for the upcoming year, it's going to be all about weather from this point forward. We obviously cannot, with these acre numbers, we have to make sure it puts a little bit more premium on growing a crop with a very strong projected demand moving forward. So that's going to be the key next week. Continued planting pace as these wet areas, North Highway 20, south of 90, is going to be something to keep an eye on. Northern Iowa, southern Minnesota, across the state over into Wisconsin. Well, at the time of this recording, we have yet to see our commitment to traders report for corn, but we are expecting an increase on corn numbers there. To see that we've seen some managed funds come in and continue to add to their longs. That's through Tuesday this week. We may have seen a little bit of liquidation. Come Monday morning, we're going to want to take a look at open interest to see if maybe that gives us any insight as some of these established managed fund longs may have done a little bit of liquidation here today and upon the release of the report. Taking a look at the soybean balance sheet. We did see the old crop carryout in beans drop down about 20 million bushels. 530 was the carryout number there, still a very large number. Increased crush 20 million bushels in that old crop balance sheet. The key was taking a look at the new crop, punching in 90 million projected acres at this point, throwing yield estimates, demand estimates in there. That number came out much tighter than what the trade had anticipated at 415 million. Still very plentiful amount of beans, or an unconcerning carryout number, but the trade was looking closer to the 530 level. So we've seen almost 130 million less than projected there. So the USDA was very aggressive on their demand estimates for the upcoming year for both crush and exports, which historically they've been a little on the light side, and they've been very aggressive the last couple of years. So that's going to be the starting point for beans. When you take a look at the charts, and the July contract, 1090 has been the high. $10 actually trading below there today. We are right at the bottom end of this trading range in here. and that'll be the key moving forward as well. And the other question, I was talking about the commitment to traders report. We know there's a fairly large managed fund long in both corn and meal, and I suspect we're going to take a look at open interest on Monday, and we're going to probably see that declining. That would suggest that we've seen a fund hitting the sell button or get me out button here today. So it felt as if with today's hard down move, we've seen some fund liquidation. Take a look at the fundamentals here moving forward. Weather's still going to be the key. Tariffs with China is still weighing on this market as well, and exports. We do have we're in line as far as a percentage of the 5-year exports number when you match that up to the projected export number. So we're fine there. The problem is we're not actually moving them out of the country. So we are for corn, we are not for beans. That'll be the key over the next several months, is we need to start moving some of these old beans out. There's a pile of beans on the books yet to China, what's going to happen there. So still plenty of uncertainty moving forward. We did see both world production ideas drop for both corn and soybeans again. Big drop for corn. So taking a look at those world numbers, they are a little more supportive and do put a little emphasis on making sure we grow trendline yield type crop this year. Taking a look at the livestock markets, cattle futures still in a grinding mode, but we did make 5-week highs in the June contract this week, posted 108.10. We're still in that 104, 108 trading range right now. Seasonally, we're seeing some strong demand here. Boxes are trading around that 1031, 1032 area in the choice. So we're seeing some strong demand out there, but we're still stuck with a cash trade at quite a premium basis to the futures right now. And that'll be the key moving forward to see if we see that cash break, which is going to give here moving forward. There was very little cash trade yet at the time of this recording, but we are aware of customers in our office here that we're getting paid $124, $125 for June delivery cattle. Keep an eye on the boxes, I think, next week. See if there's going to be a trade materialize yet this weekend, tomorrow, early on next week. I think will be the driver here in the cattle market. Taking a look at hogs, and again the opposite of what we're seeing in cattle futures as far as basis. Got cash trading at a discount to the futures contract. May goes off Monday at a $9 discount to the June contract. So we're going to have quite a premium out there. Cash is actually stronger for the week up. The national direct trade was up about $2.50 on the week, $61.98. Looking at the $74, $75 level for June hogs, that's quite a premium. We're in a trading range, 71 at the bottom end of the June contract, 79 is the key to the top end. That looks like some tough resistance to get through. If you can get through that, maybe you can get a little bit farther, but 79 certainly would be a target to be hedging summer hogs. Seasonally, we do see a gain in the pork cutout values. Compared to the last 2 years, we're going to have to see a pretty strong rally at this point. The cutout was trading about $9 higher last year at this time. So if you have any questions about these or any other markets, please feel free to get a hold of us here at BIS Commodities at 1-800-373-2525.